You are watching Notepad. I'm your host, Ibrahim Sani. The MIA Conference 2021 is currently happening, and of course, we have covered a lot of topics when it comes to the taxation industry, and of course, all the other assurances issues that comes across when it comes to accounting. But one thing that we want to highlight is that a particular change is happening right now. Global minimum corporate tax is currently being discussed by people in the industry. And I think it's also important for us to understand the implications that it has on us, the businesses in Malaysia. So here to discuss this at length is Hooi Beng, the partner of International Tax Services and Deputy MD or Deputy Managing Director at Deloitte. Tan, thanks for taking the time to speak with us. Let's go through the context of all this because I think it's important for us to understand the global tax landscape is changing immensely. The OECD or G20 inclusive framework on the base erosion profit sharing or BEPS is also currently happening, and this includes the two proposals. Let's run through with the context of it and perhaps a little bit into Pillar 1 and Pillar 2 and what are the differences between the two.
Sure. Thanks, Ibrahim. Thanks for having me. So to give you some context, the history of this is BEPS, as just to recap, BEPS is base erosion profit shifting. Yeah. So basically, the G20, sometime in 2012, has commissioned OECD to do some work on this, to come up with some action plans with a hope to combating international tax avoidance. Yeah, because the G20 feels that the loss of revenue to the authorities in the world are immense, and therefore there must be a stop to international tax avoidance scheme. Right. For example, shifting profit from a high tax country to a low tax country, or even to tax haven. Example. Right. Now, arising from that, in 2005, sometime in 2005, BEPS 1.0, 15 action plan has been, announced, and most of it has been implemented. One of the action plan, the BEPS action plan number 1 on digital economy, taxation of digital economy, it has not been properly, adequately addressed in the sense that no consensus has been achieved as to how we want to tackle taxation arising from digital economy, because that is a difficult part to deal with. Therefore, subsequent to BEPS 1.0, OECD, G20, G7 says that, look, we need to move faster. Let's look at BEPS 2.0. So BEPS 2.0 was discussed, and it comprises of 2 pillars, as you mentioned, Pillar 1 and Pillar 2.
Okay, Tan, so what are the differences between Pillar 1 and Pillar 2?
Yeah, so Pillar 1 basically is to allocate profits to market jurisdiction. What does that mean? It simply means more opportunities for market jurisdiction where customers or clients are based in, the user are based in. That is a market jurisdiction. Otherwise, without Pillar 1, you could imagine various multinationals operating from low tax jurisdiction, for example, or even higher tax jurisdiction when they provide some services, digital services. They need not be in country like Malaysia, right? So they need not be physically there. Because of the technology, they could easily render services from their own country and making a lot of money from the developing nations like Malaysia, Indonesia, right? So arising from that, countries of developing nations will say that, how are we going to collect the taxes? So it's an unfair profit allocation. Arising from that, Pillar 1 says we will reallocate the profits to market jurisdiction, give them some opportunity to collect a bit more taxes using a special formula. So it is meant to achieve a fairer taxation, allocation of taxation, under Pillar 1. Of course, the devil is in the details. It's very technical, but basically that is the intention, to reallocate profits to market jurisdiction,
Okay, and then of course, the G7 meeting is currently happening right now as we speak, and there are new entrants to that particular meeting. Joe Biden, this is his first G7 meeting as president, the Japanese Prime Minister as well. This will be the last G7 meeting by Angela Merkel because she's not looking for re-election, and therefore this will be her final one. But on top of the G7 meetings, there's also a big announcement because the G7 nations did agree to set a minimum global corporate tax rate at 15%. And the G7 finance ministers are saying that they're taking aim at some of the world's quote unquote most profitable multinational enterprises. And this is them trying to take aim at these companies by agreeing to set a global minimum corporate tax rate of at least 15%. Now, before we jump into this, can you share with us the background to this, the whole tax haven story, the whole how BVI or British Virgin Islands or Ireland per se is currently being used before we jump into this whole tax rate of 50%?
Yeah, that's right. That's a good point. We give a background on this, why there's a need of global minimum taxes. So because each jurisdiction in the world has different tax regime, have taxes ranging from 40%, 30%, Malaysia 24, Ireland's 12.5, Singapore 17, Hong Kong 16.5, Hungary 9%. So you can imagine, right? There's a tax differences in terms of corporate tax rate. So naturally, multinational will try to make sure that their tax affairs are being handled in the most efficient manner. So when they operate cross-border, they want to make sure that less profits are booked in high tax jurisdiction, and of course maximize the profits in low jurisdiction or in the jurisdiction where there's a tax incentive, for example. So that's natural, I mean understandable, has been happened for decades and even centuries, right? So arising from that, the G7 together G20 and also OECD says, look, we need to set a minimum tax, global minimum tax, where this global minimum tax, the effective tax rate, will apply across the board around the world. So therefore, multinationals can operate wherever they want. That's okay. From economic perspective, that's okay. You choose whichever country you think suitable for you. But the point is then, regardless of the tax regime, eventually the net result is you will pay 15% as a global minimum taxes effectively. Now, let me just make one important point. Last Saturday, G7 finance minister met in London, mass to mass, and just to clear one point, the rate mentioned is at least 15%, and the language used, was in the sense that France wants to use the word at least because they believe 15% is too low. So they don't want to set it as the rate, a certain rate, but rather as a baseline minimal rate. So the rate could be higher. So 15% is the minimum rate. The question is whether this is the right rate or wrong rate. Well, it's a big question mark because in the Pillar 2 blueprint, the OECD's example only give an example of 10% to 12.5. 12.5 obviously refers to the Irish tax rate, but never mentioned about 15. Anyway, those are those examples. So the rate has not been ascertained, and this is always a big question mark. One important point, whatever OECD wants to do, whatever G20, G7 wants to do, I know there's 139 countries in the inclusive framework, but we can't deny one universal fact, which is U.S. blessing is always required to get this reform done. It is what it is, and that's a reality. So under the Trump's administration, this was not a top agenda in terms of minimum tax and also, that's Pillar 1. So under Biden's administration, he realized that because of pandemic, there's a need to raise more revenue. There's a need to also fund the bipartisan infrastructure plan of about $4 trillion. $4 trillion. So therefore, Washington wants to up the corporate tax rate and as well as the anti-abusive tax rate in US called GILTI. So he took an opportunity to say that, tell the whole world, look, I'm going to set, I want 1% as a minimum tax rate, global minimum tax rate. And as a result, he could probably convince Congress to up the rate in US as well, the corporate tax rate. So 21% was initially said, but then it was revised to 15%. Probably he thinks, the Washington thinks that 15% is more palatable. So G20 Saturday, there was an announcement, the British finance minister said it was a historic moment for right company to pay right taxes at the right time and the right place. But I'm quite confident that the 15% has been discussed even before the London's meeting, because the London meeting was a formal meeting, but 15% has been kind of like agreed officially, unofficially. So therefore, at least 15% has been ascertained. Yeah.
Yeah. Okay. While the actual tax rate currently being discussed is a hotly contested debate, my focus and attention is on the MNCs, because the biggest impact to this is not the individual taxpayer like you and me. It's actually these MNCs. And the clearest example would be companies like Google, like Apple. And in 2016, in fact, Apple was fined up to 13 billion euros plus interest. The European Commission found that Ireland as a country granted illegal tax benefits to Apple, and that the company has to pay unpaid taxes from 2014 to 2004 to 2014 to the Irish state. This is just an example, but there are many other countries like this that can perhaps be in their best interest to offer lower taxes, lower corporate taxes to these multinationals. What would be some of the catchphrase or the safeguard measures to ensure that everybody complies and there wouldn't be one or two countries that would skip around the law and say, you know what, the law is really good, it applies to everybody except us? How do we make sure that that doesn't happen when this Pillar 1 and Pillar 2 is being executed?
Right. So that's a good question. And to your point on the Apple case, that's a good point. But just to also let you know, the latest is that the court has reversed the judgment and say that Apple need not pay back to the government of Irish. So that's an interesting latest decision by the court. In any case, back to your question of how do we ensure that every nation participate in this Pillar 1 and Pillar 2 accordingly? That's a very good point. And because of that, OECD comprises about 38 countries, G7 of these 7 countries, G20, the top 20 countries. They know that for Pillar 1 and Pillar 2 to be done in a meaningful manner, it must be a global consensus and involve various countries. Therefore, hence, inclusive framework, which Malaysia is not a member of OECD, but is a member of the inclusive framework. It means the thoughts and the thinking of the other countries will be also factored into in the decision making, which is, I think, a very good thing, and that's why it's a global consensus can be achieved in that sense. Now, assuming one country says, no, I'm not going to follow all this, I don't want to be a member of international inclusive framework, what will happen then? What will happen then is that let's say country X, just country X, okay? So a US company has an operation in country X, and country X say, no, we need to follow all this. Now, minimum, let's say country X tax rate is only 5%. And then minimum tax rate has been set globally at 15%. So what will happen here is that there's a difference between 15 and 5, which is 10%. The 10% so-called top-up tax will be then collected by the US government under the BEPS Pillar 2, what we call income inclusion rules. So what will happen is that country X will just lose out, because if you don't want to follow that, you want to raise up your tax, US is going to collect the taxes, right? So eventually, each countries will say, we have no choice. Instead of allowing other nations to collect the taxes, I might as well collect the taxes by upping my tax rate. Yeah. So that's what's going to happen. Eventually, it's going to be an arm twisting, and it will be done by hook or by crook. Yeah.
How do you ensure that this kind of guideline is being practiced uniformly across all the other 100+ countries around the world? Where is the uniformity in creating this particular new structure, particularly in Pillar 1, actually?
Pillar 1, as mentioned earlier, the net beneficiary of this should be, among others, nations with a huge population, like Indonesia, for example, whereby there's a lot of customers. There'll be a huge number of customers and to buy the digital services. Hence, the Indonesian government will be able to collect some taxes under Pillar 1. That's one example. Now, how to ensure there's only one uniform rule? That is why, while G7 make a big news out of it on Saturday, I would say the devil is always in the details. I do not expect that all this will be ironed up in next year or the year after that. I would think that all this will be settled by 2025. It'll take a number of years to settle, whereby every nation's agreement, the consensus must be achieved in that sense, because no one is to be left out, so that everyone will embrace this new Pillar 1. So it's going to take a while to get consensus from everyone, but eventually, my expectation is that it will take place. Yeah.
Okay, let's talk a little bit more about the implications for the MNCs, the implications for the taxpayers. Should they change how they do their business today, even when we know that this is going to take some time? Do you feel that MNCs are now approaching things a little bit differently? I'm sure this comes to no surprise. This has been in the pipeline for 10 years?
Yes.
They're changing they should change their behavior, they must be changing their behavior, or they have changed their behavior. What is the mood like for large MNCs?
So the choice, the decision for MNC to operate, let's say, in Malaysia or in Singapore or in Hong Kong, generally are due to various reasons, and various economic reasons in terms of location, in terms of skillful workforce, political stability. And obviously, I can't deny that fiscal advantage or fiscal incentive, tax incentive offered by those government is also an important factor to the multinationals in terms of when they choose or select a jurisdiction to operate from. Yeah. So given minimum standard, global minimum standard, it simply means even if they operate in Malaysia and given a tax holiday of let's say 5% for the next 20 years, the global minimum tax rate, if it's set at 15%, it means the 10% top-up tax will be done, will be collected from the taxpayer, and who is to collect that is either the country where the headquarters is, in this example, potentially US, or Malaysia itself will collect the top-up tax through a domestic top-up tax rule. Now, so for the multinational that operates in Malaysia, it says, hey, look, we used to enjoy 5% tax, and now eventually we are paying 15%. So will we be moving out from Malaysia? Do we go to other countries? Now, if even you go to other countries, the minimum tax rate globally has been set at 15%. So in terms of fiscal advantage, whether you stay on, you move on, it's going to be about the same. So therefore, it can only mean one thing. Other non-tax factors, other X factors will come into play. And this is where the government, Malaysia, Singapore, Hong Kong, who offers a lot of tax holiday, must work out what is best in terms of non-fiscal incentive to improve political stability, to improve infrastructure, promote innovation, all this kind of thing needs to come in and then make sure Malaysia remains on the radar for investor. Now, in terms of the top-up tax, if at all this happens, Malaysian government should consider picking up the top-up tax. Means instead of allowing foreign country to pick up the top-up tax, Malaysia should collect the top-up taxes and then use the taxes, for good purposes, to spend on the proper infrastructure and R&D and so on and so forth. Therefore, to make sure we continue to spur our economy, to make sure the foreign investor feels safe and continue to have greatest confidence in our nation. Yeah.
It seems like we're working with a frenemy kind of situation here. All the countries around the world want to have a global minimum corporate tax, but at the same time, they don't want to lose investments, and there are inherent benefits to operating in one particular country over the other. That seems to be taken away if the tax rate is uniformed across the board. Say, for instance, a small country like the Canary Islands or Labuan or whatever, right? They only benefit because of that low tax rate. But if you take this away from them, you're allowing only big countries to enjoy investments. I'm not just talking about US and Europe and all that. I'm talking about in this region. Why should a company move out of, say, for instance, Singapore? Because of the infrastructure. It's very good. Indonesia, it's wide. There's like 200 million consumers there. How will countries potentially lose out by having a global minimum tax rate? Is Malaysia at risk of losing out investors?
Thanks, Ibrahim. That is really a very good question, and I think the all of us, including the investment agency, definitely must look into this. And I would say whether Malaysia will be at risk or not, it really depends on what is our strategy moving forward. Yeah, knowing that G7 has announced this. The investment agency in Malaysia has some ample time working with the Malaysian government to stabilize things and to come up with some strategy, non-tax strategy, right? So, for example, in terms of innovation, in terms of digitalizations, in terms of infrastructure, I think Malaysia will need to continue to spend wisely on all these things, because we want to tell multinational investors we have good infrastructure, and indeed we do, and we continue to invest in that, and we continue to uphold the rule of law, we continue to ensure intellectual property is being protected accordingly, so on and so forth. So if we can ensure that that takes place, then Malaysia will continue to triumph with or without tax incentive, right? So those non-tax incentive factor is going to be very crucial. Indeed, when G7 had the meeting last Saturday, the Economic Development Board of Singapore came out with a statement to say that, regardless of tax factor, Singapore has been always a popular jurisdiction for investment because of non-tax reasons, and as you mentioned earlier. And obviously, Malaysia, in my view, is capable of doing that. And indeed, if you could recall, we have a lot of foreign investors in Malaysia, manufacturing, high-tech industry, and I guess investment agency like MIDA, Invest KL, and all the corridors agency will continue to do their part. I'm quite confident about that, but work must start now to make sure that we are aware of the ramifications if we don't do that. Yeah.
Okay. When this idea was mooted, it was brought forward by the US government, and I believe it should be coming from the Obama administration more than 9 years ago. And the reason is because they don't want their companies to run away from the US, Silicon Valley companies, heavy industry companies, because they are losing tax revenue from them. And not to mention the billionaires and all the other family investment houses that are also losing out because of capital gains tax not being realized in the US. The issue now then is this. There are inadvertent effects that might take place. For instance, now no country is going to go higher than the tax rate that will be decided. If it's 15%, 15% lah. If it's 21, whatever the rate is, that is it. Because there is no incentive for a country to charge, let's say, 35% corporate tax when all the countries around the world is charging 21%. Am I deluded in this, or is this a reality that might take place?
Yeah, that's a good point. So the 15% is at least 15%. So let's assume it has been fixed as 15%. The other foreign countries that have higher tax than the 15%, they probably may not necessarily bring down their tax rate. But those countries with having corporate tax rate below 15% is the one that will be feeling the heat, because either they up their rate to 15, or other government or other nations will be collecting the differences. Yeah, who will be adopting this Pillar 2 rule. So actually, the pressure is more on countries with tax rate below 15, or with countries with tax rate above 15 but offers various tax incentive, whereby eventually the effective tax rate has gone down 15. So the pressure is more on that. Other countries like US will not bring down their tax to 15%. Indeed, they are supposed to raise their corporate tax, to finance the 4 trillion infrastructure.
Malaysia is not known for having Fortune 500 companies. In fact, there's only one in Fortune 500 company there. But what would be some of the impacts that you can foresee when it comes to Malaysian companies with these changing tax laws that is happening?
Okay, so the impact is really on foreign subsidiaries or multinationals. So the question is, what happened to Malaysian company itself operating domestically? That will not be affected per se. But if Malaysian company having various operations overseas, now that we have to obviously that may have an impact, because for example, Malaysian tax rate is at 24%, right? And then if you operate in those countries that are having taxes, let's say below 15%. So the question here is that there is a top-up tax to be collected, and Malaysia probably have to then enact a rules and to follow what you call the income inclusion rules to collect the differences. Because if Malaysia doesn't do that, then I think the country where the taxes is below 15% will take opportunity to do the top up themselves. So the question is whether who is supposed to have that revenue. But you're right. This Pillar 2 rules, right, applies to huge company and not the small and medium enterprises, because the threshold for the group threshold is euro 750 million. That's quite a huge amount. Group revenue.
Where does Malaysia lie when it comes to making this work for us? Do you think that the Malaysian tax authorities are in the thick of it, or are we going to be roped into the conversation down the road? Where do we stand? Do we need to take leadership on this?
Yeah, thanks, Ibrahim. And I on this point, I give full credit to the Malaysian Inland Revenue Board, together the Ministry of Finance, and also the various professional bodies there, together with the various chambers of commerce as well. the tax agency in Malaysia are fully aware of this and indeed already acting on it. They are fully aware of the implications. They are studying it carefully, but definitely not a new thing to them. Indeed, various consultations have taken place, and Malaysia, to me, is quite prepared for it in that sense. On Pillar 1, actually, if you think about it, on Pillar 1, I remain hopeful that because all Malaysians love to do this online acquisition, online purchase, and some online services, digital services, I'm hoping that Malaysia will be the net beneficiary of this under Pillar 1 because we are the market jurisdiction. Yeah. So hopefully we are the user. Hopefully the Malaysian government is able to collect some taxes out of Pillar 1. In terms of Pillar 2, really here, the impact is really on our Malaysian tax incentive regime, which I mentioned earlier. But again, the government, based on my understanding, they are really looking at this as well. So I mean, we are in a situation where we are recovering, but still facing the COVID. But if you look at it, eventually, I only have one important message: is that the political stability part, we must improve on that. Together with other factors, I think the non-tax factors, I think we'll do fine, but we really got to focus on the non-tax factors to tell the whole world we are still a favorite jurisdiction for people to invest in.
Yeah, sorry, you read my mind because two things. You read my mind twice. The first is, are we going to be a net beneficiary? And based on your understanding, you feel that in Pillar 1, we could be the net beneficiary from this. But of course, the realization of this is very long. It's not going to be next year or 2 years from now. It's going to be 4, 5, 6 years down the road. But the second thing that you read my mind about is on the political risk that is currently, I guess, increasing. I've read some reports from all the rating agencies. It doesn't look good when it comes to the rising political risk. Do you feel that this needs to be addressed urgently in order for us to continue to show the world that we are an investment destination? Where do you stand on this?
Yeah, that's a good point, and I take a personal view that the current government is doing their best. I mean, we are in uncharted water, obviously, but in terms of political stability, I think the current government is really doing their best as well. It's not easy. It's not easy task. Yeah, and working together, of course, with various parties, they're doing their best, but it will take a while, and I hope. By let's say, for example, by mid next year, by the end of next year, things will be clearer in terms of our direction. But we still have some time, but our work must start now. But all in all, yes, I mean, various rating agency have some concern, but personally, I still, as a Malaysian, I still have very much confidence in this country, and I think we will be back on the world stage again very soon. Yeah.
All right. Thanks, Tan. That was Tan Hooi Beng, the Deputy Tax Leader at Deloitte Malaysia. There's plenty of things that can be discussed further from this, so I urge you to look for further resources on astroawani.com, look for Deloitte or taxation, or go to Deloitte Malaysia and find more resources there as well. Until then, thanks very much for watching. Catch you in the next one.